There are only two ways to make money in this world. You can work for it, or you can own something that does. And surprisingly, most people spend their entire lives stuck in the first category. They show up every day, put in the hours, and get paid. But the moment they stop showing up, the income stops too. What most people don't realize is that there's another system running quietly in parallel, a system where money continues to work even when you don't. That system is called ownership, and the most accessible form of ownership ever created is a stock. Meet Daniel. For the past 3 years, he's been building a coffee concept. Cold brews, single origin beans, and a shop experience his city hasn't seen before. Everyone who tries it tells him the same thing. This should be a business. So Daniel sits down and runs the numbers. Location, equipment, inventory, staffing. Everything combined, he needs $200,000 to open his shop. He already has $100,000 saved, which means he's halfway there. Now, most people in this situation would take a loan, but loans come with pressure, fixed monthly payments, interest, and obligations that don't care whether your business is thriving or barely surviving. That's a risky position to start from. So Daniel chooses a different path. Instead of borrowing money, he decides to sell ownership in his business. He takes the total value of his company and divides it into 100 equal pieces. Each piece is called a share, and together, these shares make up the company's stock. He keeps 50 shares for himself, giving him 50% ownership and control. The remaining 50 shares he offers to investors at $2,000 each. 10 investors step in, each buying a portion, and just like that, Daniel raises the remaining $100,000. No debt, no interest, no monthly burden. Just a group of people who now own a piece of what he's building. Now here's where things get interesting. What does it actually mean to own a share? Imagine you're one of those investors. You buy 5 shares for $10,000, making you a 5% owner of the business. You're not working behind the counter, you're not managing employees, and you're not involved in daily operations. But you still own a part of the company. And that ownership comes with 2 things: a share in what the business owns, and a share in what the business earns. If the company grows, your investment grows. If it struggles, your investment declines. It's that simple. A stock is not just a ticker symbol or a line moving on a screen. It's a slice of a real business, with real revenue, real expenses, and real risk. That's the fundamental difference. Some people work for money, while others own things that produce it. But here's the part most people overlook. If Daniel initially priced each share at $2,000, why would the price ever change? The answer is simple. Because after that initial sale, Daniel no longer controls the price. The market does. Let's fast forward 18 months. Daniel's shop is thriving. There are lines out the door. Customer demand is strong, and the brand is growing. Now, people who ignored the opportunity earlier want to get in. They approach existing investors and offer to buy their shares. But now, instead of $2,000, they're willing to pay $3,500. Nothing about the business changed in the last 5 minutes. What changed is perception. People now believe the business will be worth more in the future. This is the core driver of every stock price. The supply of shares is limited, but demand constantly changes based on new information, performance, and expectations. When demand increases, prices rise. When demand falls, prices drop. Stock prices are not just a reflection of what a company is worth today. They represent what people believe it will be worth tomorrow. And understanding this one idea changes everything about how you see the market. As Daniel's business grows, another challenge emerges. There are more investors, more transactions, and more complexity. Buying and selling shares through personal connections is no longer practical. What's needed is a centralized marketplace, a place where buyers and sellers can meet, where prices are transparent, and where transactions are regulated. That's where stock exchanges come in. In the United States, the largest ones are the New York Stock Exchange and the NASDAQ. Every day, billions of dollars flow through these markets. When a company becomes large enough, it can go public through an initial public offering, or IPO, allowing anyone with a brokerage account to become a shareholder. This isn't just theory, it's how real companies started. Take Starbucks, for example. When it went public in 1992 at $17 per share, it was still a relatively small coffee business, but investors who understood its potential and bought early saw significant long-term growth as the company expanded globally. The principle remains the same. Ownership in a growing business can compound wealth over time. But not everything moves upward. Let's go back to Daniel. 2 years later, a well-funded competitor enters his market with aggressive pricing and heavy marketing. Customer traffic drops, revenues decline, and investor confidence begins to weaken. As uncertainty increases, investors start selling their shares. But now there are more sellers than buyers, and when that happens, prices fall. The same shares that were once worth $17,500 are now valued at $7,000. Nothing illegal happened, and no one made a mistake. The market simply adjusted its expectations based on new reality. Because the truth is, the market doesn't care what you paid for a stock. It only cares what it's worth now. This is risk, and it's not an exception. It's the normal condition of investing. That's why experienced investors don't put all their money into a single company. They spread their investments across multiple businesses, industries, and asset classes so that no single event can wipe out their entire portfolio. This approach is called diversification, and it's not optional, it's essential. When you step back and look at the full picture, everything becomes clear. A stock represents ownership. A share is a unit of that ownership. When you buy shares, you are buying into a business, its future potential, its performance, and its risks. Companies issue stock to raise capital, and investors buy stock because they believe in future growth. The stock market simply connects these two sides through a system driven by supply, demand, and expectations. Most people will spend decades working for money, but a smaller group builds something alongside it, an engine powered by ownership. And now you understand how that engine works. If you understood this, you're already ahead of most people. Subscribe if you want to go deeper, because this is just the beginning.